As markets edge closer to 2019, there are a growing number of voices that are warning that we could be getting closer to market turmoil. Oliver Wallin joins us now from Octopus Investments, where he's an investment director. Good to talk to you. How would you assess the current climate for investors?
Okay, well, I don't think you need me to tell you that things seem to be very finely poised at the moment. We are clearly at the end of what has been a prolonged bull run. Investors have enjoyed what has over time been a bit of a one-way bet, and now it's time to really recalibrate as we look forward into 2019. There are lots and lots of factors at play at the moment for investors to be aware of.
What would you regard as the biggest features, the biggest factors to watch out for then?
Well, I think there are a number of key factors that we're looking at. The first is global growth and the question of whether that has peaked, and that's kind of been addressed and answered in the IMF's recent report. We have monetary policy, particularly in the US, and a tightening of monetary policy there, the only meaningful tightening that's going on. And that has a real impact on where we move through the investment cycle. And then there are lots of geopolitical risks with pretty binary outcomes that have been weighing on investor sentiment for some time. And the most predominant of those is the trade war, or the trade spat at the moment between the US and China, which is coming at a bad time for both economies. We're conscious of how China manages its slowdown throughout 2019. And then we have other geopolitical factors like Brexit and the Italian budget as well.
So let's take a look then very quickly, if we can, at the risk for the growth outlook. We've already seen the German economy strike a negative growth number, or contraction. Do you see more of those happening, or do you think for Germany and for those that are seeing a shrinkage in GDP, do you see that bottoming out?
Well, I think the important thing is our first factor that we look at is the IMF report, and it has revised its growth forecasts downwards, only by a small amount, 0.2%, but it's still a move downwards. It has pointed to a number of factors which I think are interesting. One is that global growth is still present and probably forecast to be at sort of 2017 levels, but that growth is desynchronizing, and there are some countries out there that may well have peaked, and the UK and Europe are areas that they have looked at. The real challenge for us as investors is whether this is just a soft patch, and whether it is a consequence of the geopolitical risks that we've talked about and the other factors at play, or whether it is the start of something more meaningful, i.e., has growth peaked, and are we started to move into that next phase of the cycle, the inevitable slowdown. Our general view is we don't expect that, geopolitical risks aside, to take place until 2020. It's going to be US-led, and it's driven in the main by the monetary policy that the Fed is adopting.
You talk about the binary effects of these geopolitical risks. If the geopolitical risks were factored out, would you be happy fully investing in the market at these levels? Well,
I think that's a good question, and from our perspective, there is an element of being very conscious of the upside potential, particularly in equity markets at the moment, as well as being conscious of the downside risks. Now, you do tend to focus on the things that you do know, and monetary policy and the Fed is part of that. Generally, sentiment has been weighed on by the geopolitical risks. You can see that when the ceasefire was announced in the G20. We saw a pickup in the S&P 500, a short-term pickup, but we know that that is evidence of how these factors are weighing down. So I do believe that should some of these factors move away, or all of them, and the trade war is the most key element, there is upside potential in equity markets across the globe, particularly in global emerging markets, Japan, that are geared into the kind of global growth and global trade, and that's something we're very wary of. And when we talk about binary, I mean, that could, under Trump's past showing, could happen very quickly, and then we can focus then again on the fundamentals, which in the US still looking pretty good.
Yeah, from a multi-asset point of view, where is it best to be placed then in that case, in this situation?
So from a multi-asset point of view, I mean, we are investing across a range of different asset groups, equities, bonds, and then everything else that doesn't look like an equity or bond, and we call that alternatives. We're spreading across those asset groups for just a general smoother long-term investment journey for clients. Short-term is about tactical positioning and what the prevailing environment was, and probably the biggest influence on returns for 2019 is going to be how much risk you've got on the table, how much equity exposure you've got, where you're allocating it, and how effective your tactical short-term decisions are likely to be. So our decision is about, we still want equities to be the driver of returns. We still expect that over the long term. We still have a suspicion there's upside in the short term. We use bonds to diversify equity risk, but bonds themselves are looking fairly vulnerable in an environment of raising interest rates. So we are letting our alternatives and cash as well on the sidelines diversify that equity risk a little bit. It's going to have to do some more heavy lifting for us in 2019.
Well, if when the downturn comes, is it, in your mind, going to be something spectacular like some are talking about, and with the amount of debt that we've got, corporate, personal and so forth, it's going to be a cataclysmic event, or do you not think anything like that?
I could be a hostage to fortune here. I guess that you start by focusing on or understanding that there are a lot of unknowns out there, a lot of factors that we are not in control of, and they always have the potential to create some kind of black swan event. But actually what we're looking at is probably more of a transition, which is what normally happens in the event of through your investment cycle. And the key catalyst for that in a normal environment, and we know every investment cycle is different, everything has its own idiosyncratic features, but normally you would look to monetary policy as being the key trigger for that. So again, we have to talk away about the unknowns and the binary risks and say, in a normal environment, you'd be looking at the Fed to manage this the rate rises effectively. They don't want to move into restrictive policy, which is the trigger for slowdown recession by accident, but that is by its nature not an exact science. So that is the thing that we are focusing about. You know, behind the scenes in the US economy is still growing great guns. It's still benefiting from fiscal stimulus, which will be on the wane through 2019. So our base case, and we feel from the markets and the investors whom we access, it is more of a transition into a slowdown that is going to be driven by the Fed and is likely to happen at the end of next year and into 2020.
So for your clients, is it a question of going to global funds, or is it really minutely examining every single investment through active management? Does that play an increased role?
Yeah, I think this is, for investors who've been in the markets for a long period of time, this kind of volatility is kind of what you'd expect normally. It is an environment where active management tends to earn its salt, as it were, and it should create some opportunities for dynamic investing. Now, we are not short-term, so our default option when we go into every year or every period like this is to look at where our long-term neutral positioning is. You know, how much equity risk have we got, and how much and what are we offsetting that risk with, informed by the mandate of the investor. So it is a balanced portfolio. We're only looking at the short-term environment to make some additional alpha that we can add to the portfolio through some kind of timing decisions. Now, market timing is notoriously difficult. We don't want to be the wrong side of that or becoming more emotive about it. Our short-term plans for the next year is really about being mildly underweight our long-term view on equities, but being opportunistic. You know, we are looking to buy on market dips, to buy, buying into this idea that at any time these geopolitical risks could go away. There is upside potential in markets, and you know, maybe we still haven't seen the kind of last hurrah in risk assets before the cycle ends, and those are the kind of questions that we need to wrestle with on a regular basis.
Of course, it's all about timing.
There's a lot about timing for 2019, and that we are not market timers, but for short-term investors, well, even on that, there's a lot to factor in here. And I guess the real concern for anyone trying to get involved in market timing is to try and take the emotion out of it. And the more you get sucked into that short-term movement, the more emotive you can be.
It's a pleasure. Look, wish you all the very best for 2019 at Octopus Investments. But in the meantime, Oliver, thanks indeed for joining us. Oliver Wallin is Investment Director at Octopus Investments.